Good morning, everyone. This is Joe Scarice. Welcome to the Creative Birth Strategy Podcast, your co-founder and co-host here every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. I'm really excited about our discussion this morning. We took the last week off and took a little break, so we got started here. We'll start inviting some people in. Today's discussion is about niche versus mainstream real estate, which we're gonna tie in. We're a little past the mid-year. Let's see what's going on with people's thoughts. We're gonna update people on the market, some thoughts to the market as well. There's some things I think I'm going to be announcing today that could impact some of the investors out there sitting on the sidelines, kind of thinking about making some moves. Let me just invite some people in on Clubhouse because we're here live on Clubhouse every Sunday, 9 a.m., 10 to 10 a.m. So we're pretty consistent with what we're doing here and providing, which is the education insight, updates, a different discussion every Sunday morning. We are actually officially booked out till December 1 with subject matter, so I'm pretty excited about that as well. So I'm just going to move as quick as I can. There we go. Get a couple other peeps in here. Invite some people in as well. All right. I think we're live also on LinkedIn. We'll find that out in a few minutes. Yardell's working on that as well. We'll get rocking and rolling. So I want to thank our sponsors, of course, always, because without them, we wouldn't be here. I want to thank Lenmar Capital, where I am a senior loan analyst providing asset-based lending nationwide for clients throughout the country. I'd like to thank MB Capital Solutions, your unsecured business line of credit program, where I'm a referral partner for the past decade, providing unsecured business lines for real estate investors and professionals throughout the country. I'd like to thank Real Estate Mastermind Strategies, where we're holding events now in Delaware, New Jersey, Pennsylvania, New York, Connecticut, soon to be Maryland. We're spreading out there, getting some really good insight out there for our real estate investors. We're actually collaborating with the Sub 2 Community and Owners Club, which I'm excited about that new collaboration as well. I'd like to thank Realty 411 with Linda Pelagas, who provides a national publication and national events through for real estate professionals throughout the country. Perkatech, Mr. Yordell Perkins, who supports all of this, our podcast, our social media, our website design. We got a lot of new things coming up on the podcast, so just keep an eye out for it. We're doing a lot of new video work, etc., for the website. We have over 120 episodes on our website at creativebirdstrategies.com. And then I like to think, who else are we thinking today? Oh, TCS Property Management and Realty Solutions, where my real estate licenses are held for New Jersey and Pennsylvania. And that's about it for that on the sponsorship side. Let's dive into the mortgage industry space right now, real quick. Rates came down even more on the base rate, even with Powell. I don't know what they're doing there, but they are really sitting on their hands. But word has it coming into this week, we're going to see almost a quarter point to a half a pound drop in the market. I mean, I'm already seeing it on the 30-year. We're down to 6.63, 0.12 basis points. I really think it's going to bring a lot of investors off the sidelines on the DSCR side. Bridge money is already down. That's already been in place. You're looking at money at around 8.99 on fixed to rent or fixed to flip or new construction. But right now, I feel like DSCR is going to be in the sixes Monday, Tuesday, Wednesday. So if you're a real estate investor coming off of a rehab or looking to buy something, the rates are going to be working very favorably. I don't see this working in favor to the home buyer. Traditionally, a home buyer does not buy a property in mid-August unless it's a necessary endeavor. So it'll be interesting to see what type of impact, because it kind of ties into some of the articles I read this past week or have posted updates on. So we already lost a Federal Reserve Governor Kugler this week, one who actually sets the interest rate. So that'll be really interesting to watch and see where that all kind of lies over this week as well. Affordable housing is still creeping up in a lot of these urban settings. Philadelphia, Baltimore, St. Louis, Chicago, seeing a lot of problems on the DSCR side for asset-based lenders. DSCR is getting very compressed and very stagnant in those markets. So all of us are keeping an eye on that in my space. staying extremely focused on really the investor movement in those areas, because unless you have done massive amount of business in those markets, we're going to be a little cautious. We're just going to kind of be hold back a little bit. The jobs report was a little light, but the Trump administration fired the individual running those reports. They think they're a little questionable. Um, so let's get into our articles as well. Vacancy rates lead the nation some certain properties in certain states. The highest vacancy rates right now are in Maine, Vermont, and Alaska. Lowest vacancy rates are in Washington State, Oregon, and Connecticut. I like Connecticut a lot. I do a lot. Our offices are in Westport, so I do like those markets. Vacancy rates are down in almost every state but one, which is Washington. So keep an eye on vacancy rates. But I'm seeing vacancy, and I see more of a desperation of rental amounts in some of these urban cities right now, that I do see rents coming down for 1, 2, 3 bedroom apartments. So we keep an eye on that, and how that impacts the multifamily space, and that'll kind of drizzle into the single family through four family space as well. Let's get our next article. Let's see here. Foreclosure auctions jump to a 2-year high. So you're starting to see a lot of investors going after the share sales and the foreclosures. Let's see if we have any markets that are telling us that. No, it's not giving me any more detail, but our foreclosures are up from 34% in the third quarter to 38%. This is an article based on auction.com. And then our last article that caught my eye this past week, U.S. housing inventory nears a 5-year high. Interesting. All right. So it's climbing, the inventory. Now, is it a good inventory is the question of the day. Buffalo's up, Cleveland's up, Hartford, Connecticut's up, Detroit, Michigan's up, Pittsburgh, Pennsylvania's up. Home values fell in a couple of metro markets. San Jose, California, no surprise here. San Francisco, definitely no surprise. Miami, Florida is leveling off a little bit. Austin, Texas, and Tampa, Florida are all strong indicators of how the market is leveling off in certain of the major cities. All right, so let's get here. I'm going to clean this up for a quick minute. And then we'll talk about, you know, niche versus mainstream real estate investment strategies. What does that really mean? It's a useful way of going after what your goals are, right? Mainstream strategies, traditional, widely adopted investment approaches that are familiar for most investors, single family rentals, fix and flips, long-term buy and hold, and or multifamily 2 through 4. Some niche strategies that you might want to consider: specialized, less common approaches that target unique opportunities often require deeper knowledge or specialized operations. Midterm rentals. I'm having a lot more conversations with midterm rentals. I'm also having more discussions with individuals that are attempting the senior assisted living facilities, student housing, rent by the bedroom. Got to be cautious with that, and you got to talk to your lender on that as well. Then there's obviously creative financing, the subject to and the seller financing. And then there's opportunity zones and tax lien investing. Now, mainstream, risk level is lower. Obviously, the niches are a little higher. Competition on mainstream is higher. The niches are lower. The barrier to entry is lower on the mainstream. The niches are actually higher. And you really do need some expertise or experience required, or a partnership. Cash flow potential on the mainstream is very steady. You got your 12-month leases. Now, in the niche products, they're higher with operational complexity. Now, the financing options in the mainstream are readily available: conventional, DSCR, non-QM. But on the niche, often need creative or private lending. And then scalability on mainstream is easier to scale, where the niche product is slower but more strategic. Mainstream, the market sensitivity more affected by economic cycles, where the niche can be resilient if hyper localized. Management is often hands off with property management. On the niche products, you're definitely going to require hands on or niche operators. And when you're considering niche strategies, you're in a saturated or overpriced market. You want higher cash flow or unique tax advantages. You also want access to specialized teams or operators. You're also looking to stand out in the competitive investor landscape. When you're sticking to mainstream, you're new to investing, you're building foundational assets. Your value and predictability and stability over maximum returns. You're also focused on long-term passive wealth building. Many top investors mix both of mainstream and niche. They use mainstream strategies to build a solid foundation and sprinkle in some niche plays to boost returns or create short-term wins. So this is where we're starting off our discussion this morning. Also, I want to remind everybody we got some great events this week. We're in South Jersey tomorrow night with Bob Chesak talking about LLCs. Tuesday night, we're in Middletown, Delaware. Thursday, we're in Connecticut and Westport and Norwalk, Connecticut. And then this Saturday, we're having an underwriting white label marketing course at my offices at TCS at 2nd and Chestnut on the rooftop. Saturday morning, 10 to 12. We're going to teach people how to broker, underwrite, taking their business to the next level. Good morning, Amy. Welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning: niche versus mainstream real estate investments.
Yeah, morning, Joe. To be back. I tried to do you justice last week. I really did. I guess, as a podcast host as you are, but fun. Well, in your absence, for sure. We had fun.
Excellent.
Yeah. So niche. So there's a couple. I'll do like a couple of challenges with the niche real estate investments. I would say first is there's not as prevalent of lending. Say you're going to do self-storage. It's very difficult for people to kind of underwrite self-storage, and there's like a smaller lender pool that understands self-storage. If that's, I don't even know if that's really a niche, or say RV parks or something like that. You're just going to have to learn who those people are, but that also can be a bonus too, because once you get in with that group and they understand this is what you're doing, then it becomes, you become known because it's a niche real estate investment, and it really can be used in your favor if you understand that. So there's a challenge in the fact that if you're new, there's not as many lenders, but once you get your feet or something, under your belt, it'll be a power for you, right? So those are a couple of things. And then I would just say that, if you're doing the deals by yourself and you're not having to raise capital, then okay, do niche all day long, as long as you truly understand it. And then, but if you're going to go raise capital, it might be a little bit harder on a niche investment versus a mainstream one. So you just got to kind of understand that investors' preferences change like by the hour. Like, dear Lord, it's like the next greatest investment's coming up, and oh, you're not in that space anymore. Oh, okay. So yeah, it's interesting. But especially in in the area that I'm in, I serve the data center industry, and the data center industry is not like freaking on fire. But even then, that's changing by the minute. So yeah, I think those are my thoughts so far. Half a nickel, Joe.
I like it. So let's talk about what you're looking at right now. You and I are having a discussion. It's kind of nichey because you got to have insight for the future. So you're looking at this four family, and you're looking at the market around it, and it's a very nichey because now you're going to try to do a luxury redevelopment, single family. Where are you at with that underwrite and review and thoughts that's very nichey because you need the right team to kind of take that deal down. We'll talk about that for a few minutes if you have some insight on that.
Yeah, for sure. So it's going to be a showcase home. So we're doing this partly with the U.S. PropTech Council. So we're going to let like the technology members and the material suppliers and folks that are in the council kind of participate on this project. And we're going to be filming the whole thing from like design to build, like closing on it, all of that. We're going to be filming this thing. And so a lot of so what I'm running up against is Well, number one, I can't get true comps. So what happens in this neighborhood is people buy homes, same square footage, but what they do is they knock them down and build a brand new house. So the true valuation of my home will be what the post build tax valuation, if that makes any sense. So you can't look at sold because that doesn't make any sense because they didn't keep it that way. They dozed it and built a brand new house. So if you go look at the back, and that's what I had to do to some people on the investor side. I said, look, this is what this neighborhood is. You just got to understand. Everybody buys these piece of junk houses, they doze them, and they build brand new 4,000, 5,000 square foot houses on them. And then I had to show them, like, look, you can see when the property, the improvements value went down to basically nothing, and then the next year it was up at $5.2 million. Like you can see this, right? And so, there's been hurdles there. There's been hurdles because my price per square foot of construction is lower, but that's because I'm getting materials donated and I'm getting, so we're fighting through all of those things, and I can explain it away. That makes sense. But and the price per square foot for building luxury in Austin is it's astronomical. If I was not going to get stuff donated, no joke, it's close to $700 a square foot in Austin. That's what the high-end luxury homes are getting built for. And so I'm just like, yeah, wait, well, I don't need to do that because I'm getting my concrete and I'm getting my framing and I'm getting all of my stuff donated. So knock it off, y'all. But it's interesting. But yeah, it's very nichey, I guess. I didn't think it was nichey, but you're right, it's nichey for sure.
Yeah, because it's not what it's going to be at the end result a year or two from now. And I came back to you with a niche objective. Hey, listen, let's talk about a shorter prepay. Let's talk about an interest only, spread it out over 30 years because you're going to need a year to kind of do all what you're doing. And then and then you get past that prepay, and then all of a sudden, your money is really cheap considering what you're going to do next, but you got to figure out what you're going to do next because now you own this 4 unit property. You're either going to have to vacate the tenants or develop it into this luxury style home in the market where it's deserving of it. And I find that nichey. I find that you need a better group, a team of experts, because you got now your only thing is you got to find comps to justify a year from now, which is a little difficult.
Right.
Okay.
A couple of houses that are actually for sale, and if they'll sell in the next year, we should be fine.
Yeah.
At the price points that they're for sale, and they probably will sell at that price point. I think that's what everybody. You obviously underwrite for what's happening today. You can't underwrite for anything in the future, and nobody would, no bank would allow you to do that. No good investor would allow you to do that, right? But we have no joke, 2.5 years before we sell this thing. We're going to spend the first year doing design and getting permitting and all the groundwork and all the other stuff we have to do. And then we start pushing dirt, a year from now, and then we're done in about 18 months or so, and then we're selling it, right? Yeah. So, based off of and this is another thing I wanted to ask you too, was John Jordan came on, he was on, I can't remember, some news show my dad watches, whatever, or John Jordan talking about how because of the tariff deal or the deal that Trump just made with Europe, and we're going to be bringing in $300 billion, and we're at 27 billion right now, or I don't know how with it, in new tariff money, that the bond market's going to take notice, and therefore they predict by Christmas we're going to be in lower interest rates.
We're going to be in lower interest rates this week. We're going to see a 1/4 point to a 1/2 point difference. I've been pushing it out there, the narrative. Right, we had a big meeting on Friday with the board, and we are dropping DSCR almost a full 1/2 point. I'm trying to get it out to as many of my sources as possible because when I did the announcement for the bridge money dropping to 8.99, my portfolio of loans went from 50/50 DSCR and rehab to 70% rehab loans to 30% DSCR. So we want to balance that out a little bit. A full 1/2 point in the multifamily small balance between 8 and 12, 5 and 12 unit multifamily is going to be significant going into this end of the year quarter. I do see rates in the sixes. I don't see rates in the fives, but I see rates in the sixes, depending on credit score, loan to value, the DSCR of the property, the asset type. It's going to get very aggressive this at the end of this year. I think we're in for with the tariffs working in our favor, where Trump is just hammering these people. There's going to be surpluses where the market is going to just like they're literally going to take their hand and take Powell and the Fed and take them right out of the way. They're becoming so. I think what the administration is doing is making the Fed irrelevant. And this week, as rates drop down more, I mean, listen, the conventional rate going into Monday just dropped another 12 to 15 basis points. So how that reflects in the investment space, it's at least a quarter, maybe even a half a point difference. So for my clients that are looking to take out their burrs right now, and I'm floating their rates, they're gonna jump on that a half a point. That's a big difference. And in Pennsylvania, in certain states, there's no prepayment. So if it falls any further and you're not over leveraging yourself, you can come back and do a refinance in 26. I was listening to PBJ and a couple other commentators in his podcast, and we're looking at 26 to be unbelievable if this all comes together. So thank you, Amy.
Say is that what if newer investors, what you need to understand is when the rate drops, values increase.
I know.
So it should hopefully all the stars should hopefully all align, which has never happened before, Timmy Joe. But if the stars align on this deal, it's going to be sick and it's going to be awesome.
Yeah, and I appreciate Amy taking over for last week, and I look forward to having further discussion this week on this project coming up. So Amy brought up a very good subject: raising capital for investment strategies require a very targeted approach, as traditional investors may be unfamiliar, uncomfortable with unconventional natures of these opportunities. So you got to put framework together to effectively raise capital for niche investments or mainstream investments. So you got to really write it out. You got to write out the strategy. You got to show the market demand, show the ROI potential, and back it up with your experience and your partnerships. Building that foundation first, creating the track record, building your brand online, putting together professional deck and pitch materials. I'll give you an example. This past week, a developer I've been working with for the last decade, he finally has taken AI and wrapped his arms around it. His deck presentations on his construction deals now are so clean. I'm able to get terms within hours because it's not as convoluted. It's clean, it's easy reading. It attracts the right capital, private investors, family, and friends, family, and network, high net worth individuals as well. Going in, trying to raise capital at investor groups and meetups or holding your own. I've been presented the idea to raise capital at my events that I hold. I don't feel comfortable with that because I'm licensed in a bunch of different things, but I do see a lot of groups focusing on that. I mean, as long as you're buyer beware and you're putting all your disclaimers out there, I think it's a smart idea of doing that, but also giving education on the way. And there's definitely other capital raising platforms you can look at to kind of get a feel of how to do it, right? You got to look at the scalability, the cash flow, the exit strategy, the risk mitigation, legal structure and transparency, and you got to reinvest and snowball, right? You got to recycle that investor capital after successful exits and offering preferred returns or equity splits to incentivize investments and creating tiers for repeat investors. Bob, good morning and welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning, niche versus mainstream real estate investments.
Hey, good morning, Joe. First of all, can you hear me?
Yep, perfectly.
Second of all, before I launch into it, Joe, you were driving, when we talked on the phone, you were driving back from North Jersey last night, correct?
Yes, sir.
Did you hear what happened in Bergen County about 2 hours after you called me?
Nope.
3.0 Richter scale earthquake, Hasbrook Heights.
Man, I leave such presence there. I create earthquakes. Is that what you're saying?
Yes, the shock wave of whatever you did up there, it resonated for hours, and finally the earth couldn't take it anymore and shook everyone to hell while it tried to go to sleep.
The Scarice made his presence. Unreal. Unreal. I believe it. So what's going on this morning, Bob, on this discussion?
So my name's Bob Chesak, president of Chesak Corporation. I help set up LLCs. I'm not here to give legal advice. And as Joe said, for anyone in South Jersey, I'll be presenting tomorrow night at Joe's event in Haddonfield. Check Joe's link above to get the schedule on that. It'll be 6:30. What's the name of the venue, by the way?
The Tap Room in Haddon Township.
So I know exactly where it is. I never remember the name of the place.
It's changed a few names. It's changed a few names in the past 10 years. So
yeah. So looking at niche versus mainstream, what I always tell people when they're looking, and like I said, this transcends not just real estate, but into other areas of business as well. There are people that are going to make money in the mainstream world. There are people that are going to carve out a niche for themselves, niche, whatever you call it, for themselves, and they'll do well. For example, in our industry, we focus only on certain types of people trying to start businesses lately. We tried the mainstream thing. It doesn't work. We're not going to be able to go up against the big boys with that regard, where people can just go online, Google it, and fill out a form. We work more with the people that need more specific or customized solutions for setting up companies, in particular with real estate people. But the point being, the one thing I always caution about, it's okay. Like I said, you can make money both ways. Just be very careful if you're trying to do absolutely everything, because even setting up the structure for that to get the funding might have to be used for certain purposes. Having different corporates, if you're doing different types of business lines, mainstream versus a niche, or even just different types of deals, you might need separate corporate or LLC structures with each of those, because how they're taxed can actually make a big impact to how much money you make. There's a huge difference between people that do buy and rent versus buy and flips, and how the tax code treats them, just as an example. But the main thing being, before you get into a niche market, make sure that you understand not just how the market itself works, but how the actual area in which you are trying to operate in will work as well. As I've explained, that there's certain markets, I've seen it happen in the area I grew up, the Scranton area, where there is the you're not from around here and we don't want you here factor. So that has played into causing some difficulties, even for not only some of my clients, but some of my friends that got into the real estate world up there, where they just one of my good friends, he spent up until he was 15 years old, he lived in New York City. His family moved when he was 15, but he still has a New York accent 30 years later. And people talk down to him like he's some New Yorker. They give him a hard time with trying to get deals. He was purchasing rental properties in Scranton, had a hell of a time getting through with them, and even just working with the bureaucrats in the city. They're like, "Oh yeah, sure, we just want your money." But that's also partly how Scranton operates, so that's kind of hard to explain. But he was getting into the niche market and the real estate market when people started moving, and let's face it, this was a niche. When COVID happened and people started vacating the major cities, a lot of people from New York City started moving westward, skipping over New Jersey, going into the Poconos and the Scranton market. And he figured that out and had money and started acquiring properties, and was able to talk to some of these former New Yorkers simply because he grew up in New York and he literally sounds like he's from Queens. But he had a hell of a time with the city, and he continues to have problems with them because they just fight him left and right on permits. He's had problems with inspectors coming in while he got a citation from the city while he was renovating the property that was currently unoccupied. They came in, did an inspection, saw it mid-construction, and wrote him a bunch of citations. Again, just to screw with them. That's kind of how it works, unfortunately. So, like I said, understand the market you're going into, whether it's mainstream or niche, because the back end markets and the mechanics of how you set up the deal for financing, how you structure the deal for legal protection, it doesn't always help sometimes unless you understand the market and understand some of those bureaucracies or idiosyncrasies that you're going to run up against or just plain personalities of the people that are in that area. So that's just, some observations I've seen just in the past few weeks. I actually had lunch with with my friend, and we talked about this just in the past week. So very, very, very strange politics happen in certain areas, but that's kind of my thoughts. Joe, I yield back to you.
You're helping me remember a client that I've worked with this past year, and sad to say, he did not know how to play ball with the local market, the local municipalities, and he bought a lot of motels and and was working on conversions. Everything he could possibly do wrong to sabotage himself, he did, and now they're all up for sale because he ended up not knowing what he was doing. Talked a great game. He had me, I funded a lot of his projects, and now they're all up for sale. He's going to make some money, but if he actually paid attention and hired the right lawyers local to the markets, I mean, one building alone he bought an 11 unit with a 20 car parking pad. It was originally a 20 unit, and he could have the option of converting it back to a 20 unit. It was across the street from the beach, and he could not get permits because he did not hire the right people and he wouldn't listen. And now it's up for sale or even potential foreclosure if he doesn't sell it. And you just got to shake your head sometimes what these people do and what they're thinking going in. They don't know how to talk to the local talent or hire or retain the local talent to get their niche deals done. Bob?
Yeah, and to be clear, in this case, this was far more bureaucratic, and and you've spent some time in Scranton, so you get it. The whole "you're not from around here, son" attitude that people just give him. But it, he did successfully renovate the properties, and they are occupied now. So he got through all the crap. It's just the crap they put him through. But in the other case, what you're talking about, and I see this a lot with where I'm still dealing with the fallout of a record number of people that just completely drop the ball, even on the most basic things of renewing their LLCs. I had a record number of companies go delinquent this year. And I'm not counting the new Pennsylvania requirements, because everyone's still getting used to that. But I just had to explain to a client who's in South Jersey. He has multiple LLCs with me with multiple properties that are occupied and generating income. I just had to explain to him that New Jersey just shut down 7 of his 8 LLCs because he failed to file annual reports, and Delaware is going to close his holding company down next year because, again, not paying the bills. The argument is, I don't have the money. Well, no, you're not budgeting the money correctly, because once those go down, the liability just shifts to you personally. So if that's what you've already 7 out of the 9 companies, this individual's already in serious trouble. And I'm surprised I didn't give him a stroke or a heart attack when I explained to him that the bill to fix all of this is going to come in well over $6,000. Just in the state fees alone, and that's not counting what I'm going to add on, because I'm going to have to do the process 7 times. So, there's, if you say you don't have the money to do the bare bones, or to get the right people in there, you're certainly not going to have the money to fix the problem when everything goes wrong. And it's not like he can just throw his hands up and walk away unless he's willing to allow the properties to go to sheriff's sale.
Yeah.
So it's I see the same thing, and I've been seeing it more and more, especially in 2025, where people are they're making excuses not to pay the basic bills, despite talking a great game about, how much they have. And a couple of them, and not the same person, but somebody else, similar situation, botched 5 different LLCs, never paid the bills. So we put up to resign as the agent. 3 days ago on Facebook, had a picture of the new, new sports car they bought. Well, how successful I am with all this money I'm making in real estate. Yeah, I'm about to shut down all your companies for failure to maintain an agent. So, but I'm sure I'll be the bad guy and all that. But hey, you didn't pay your bills.
Well, adding to what you're saying, Bob, and thank you. I feel like communication in real estate investing is key when it comes to niche or versus mainstream real estate. I think it's so critical on how to leverage it effectively. Why is communication key in real estate investing? It builds trust with partners and lenders, negotiating out deals, right? Working with contractors or third party, navigating local regulations, communicating with the zoning boards, municipalities or HOAs, essential to avoid legal and permitting issues. A proactive approach avoids red tape and surprises and helps get approvals faster. Managing tenants or property managers, and then obviously raising capital, using tools such as CRMs and scheduling regular checkups and check-ins and follow-ups with individuals. Over communicate during projects, and practice transparency and tailor your message. I don't I think the biggest failure of the real estate investor this year so far is communication, or just not knowing how to communicate, or just not smart, and then tries to hide that lack of intelligence with not communicating. That's where I see the problems. I'm seeing that quite often right now, with a lot of this business. I get real nervous, or my intuition goes up on people that can't get back to me or can't talk on the phone. That is extremely problematic when you're trying to do one of the easier loan processes in the industry, which is asset-based lending. And if you can't get back to your contact that's trying to get you the money that you want, then there's obviously a problem with you. You got to look in the mirror every once in a while, because I'm going to call you back. I'm going to take your phone call. I'm going to stay in touch with you, right? My communication is always going to be there. I'm going to get back to you and let you know the good or bad, or whatever the news might be. I'm a big fan of just giving you news, and I feel that's key with everything. Brian, thank you for your patience. Brief overview: who you are, what you do, and your thoughts to niche versus mainstream real estate investments.
Morning, Joe. Morning, group. My name is Brian Guth. I'm in upstate New York, or Western New York. My wife and I do kind of have a blended portfolio between we do fix and flips, fix and hold, and also some Airbnbs. And what I'll kind of chat through on the kind of niche side of things is the Airbnb side. So what we do from that strategy, we actually do them by the room. I know Airbnb gets a lot of grief, and to be honest, the Airbnb platform is terrible. But that's a different story for a different day. But what we do, we have 3 hospitals in the area, one of which is a teaching hospital, and 2 larger universities. And a lot of people come into town, traveling professionals, on short-term assignments, travel nurses, things like that, and they get a stipend by their employer. So what we do, we rent out by the room, and what we also do, we do rental arbitrage. So we basically, I rent the building from Joe in this example. I tell Joe exactly what's going on. I pay Joe exactly the rent that he wants. And then I turn around and I rent out by the room to these traveling business professionals. Joe loves it because I'm taking care of this property, because I can't trash the property, because I need to make it look good for pics and whatnot for Airbnb to attract prospects, attract people coming in. So, it's you mentioned earlier, Joe, traditional, the non niche markets, it's kind of more stable, kind of more consistent money coming in. And the niche, for sure, it's higher returns, but definitely more hands-on. I tell people when they kind of ask, what's more important to you right now? Having, steady trickle of cash and being hands-off, or is the money more important to you? What's more important right now, your time or your money? If your time is more important, go with traditional. You'll be kind of less hands-on. If money is more important to you right now, you can do this kind of niche, or kind of do these this by the room Airbnb. You'll make twice as much, but you'll be involved 3 times as much. You're basically a concierge, online via messaging and whatnot. So just kind of sharing that, as far as, again, not a huge fan of Airbnbs. I think the other caveat I'll add, when I'm underwriting things, I am making sure that if something goes sideways, I can always cover the rent kind of with a traditional arbitrage, or traditional renting out traditional long-term. I do not base what I'm expecting with the Airbnb income as my basis points. I know that the bottom could fall at any time.
So I want to poke. I'm glad you brought that up because you gave some pros and cons to this, and I'm going to poke some holes through for you here. So, is there higher upfront costs in what you're trying to do with the niche process?
No, actually, with the arbitrage, actually less because I don't need to buy the property. In this case, my upfront cost is the first month's rent and security deposit, and then 10 grand to stage the house, and that'd be the same as if as far as the staging the house is constant. If I was buying the house to do it myself, I'd be looking at 10-15% down. So from that perspective, it's less entry cost.
Okay, so then I'm going to poke holes for the vacancy risk. Now you're basing your numbers on the market rent. So if in case everybody just decided to move out tomorrow, your market rent can cover the nut. But what's your vacancy look like in these type of niche environments?
Yeah, I'm consistently 83%. Meaning of all the so again, I rent out by the room. If I look across, I have 13 rooms across 3 houses. If I look at all 3 rooms, the average is it's just under 83%, I think 82 point something percent, and that's regardless if it's summer, winter. That's the one positive of going to traveling professionals. They're not coming to upstate New York for the weather; they're coming for a job.
Yeah. So then my next question would be HOA zoning or insurance restrictions or allowabilities.
Yeah, the zoning piece is a big one, and that some municipalities are starting to kind of shift away from this or kind of ban Airbnbs, and that's why I go the arbitrage path because I don't want to buy a property, that may eventually outlaw Airbnbs. So I have the arbitrage that usually, after a year, it converts to a month-to-month lease. So if tomorrow my municipality says, "Hey, listen, no more Airbnbs are allowed," I'm basically I can get out of it pretty easily.
Okay, and then operational complexity, cleaning, maintenance, client expectations. Are you hands-on, hands-off? How hands-on do you have to be compared to your regular properties?
Yeah, definitely hands-on. The cleaning piece, so we have a team. We have a great cleaning team up here we utilize that we kind of let them know when there's turnovers, they take care of that. Because of the platform, Airbnb essentially, or the guest covers the cleaning expense. I charge it to them and use that money to reimburse the cleaners. Excuse me. But it is very hands-on. Like I said, I'm, for my long-term rentals, I have 23 doors that are handled by a property management company. I, am literally hands off. I obviously pay, my maintenance, my fees to the management company, but I'm hands off. With these Airbnbs, it's much more hands on. I'm making 2 to 3 times more, essentially per property than I am with my long term rentals. But I'm spending 2 to 3 more times, more time, whether it's checking in on their properties, like you said, taking new pictures, managing requests. A lot of requests come in, so I'm definitely trading my time. I'm spending more time for more money.
And last but not least, any perception risk from the residents neighboring these properties?
I think that's definitely there. Yes. To be honest, I'm very cautious of that. I have a relationship with at least two of the properties because that is a reputational risk. These people, like, again, these are traveling professionals. They stick to themselves. It's not like someone renting the house and throwing a party, and doing anything like that. They're always very respectful. The only downside is, depending, again, if I have a 4-bedroom house, that means there could be 4 vehicles. So, maybe someone's parking on the street or, kind of, off, they're on street parking versus because they can't fit 4 cars in the driveway. That's the only rub sometimes.
Interesting. Well, thank you, Brian. And I'll be seeing you at the picnic, hopefully, this month at the Freedom First Real Estate Investors Association.
Yeah, sounds good.
Yeah, 5:30. I'll be there having barbecue, hot dogs, and hamburgers. So, sure, go ahead.
another platform. They're members of the U.S. PropTech Council. It's called Work B&B. And you should try. They basically find housing for people who have temporary assignments. So it's a different, not Airbnb kind of thing, but they can definitely find you people if you have vacancy and they need a place in your area. You just get on their platform. It's a new startup, and Yevis is a really good guy. So I would just encourage you to try Work B&B.
That's great. Thanks for the heads up. I appreciate that.
Yeah, Amy, can you put that in the chat, please? Amy?
Yeah, I'll do it.
Thanks.
Yeah, for sure.
Thank you. Good morning, Chris. Welcome. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to niche versus mainstream real estate investments.
A little bit of both, but I just to follow up on the Airbnb port. What Brian can also do is we had 2 twos above our Jacksonville property. We split it up into basically a beautiful hotel. We were 4 blocks away from a hospital, and we rented them out to we Airbnb'd it to traveling nurses. So we were just doing it direct, and then there were so many of them, we just went right to the hospital, and they just bought all 8 rooms every month. It was great. So if I were you, I'd go to the local employers and go to the HR departments, tell them what you got, and then you'll be able to, it was reoccurring revenue that we could count on. So that basically paid for our employees' salaries for the year. So it's something to think of. But I do the value add apartment complex, multifamily. Also doing a couple flips and buying a resort in upstate New York, and have a couple other different investments too to spread it around. I own a car wash, and I'm looking at some more. So, but you have to be diverse in today's economy. I would not stick into one niche because you never know what's going to happen. You got to spread your, mitigate your risk and be a stress test to keep your money working at all times.
Thank you, Chris. Any thoughts to anything with Amy or Brian or Bob brought up as well? I haven't had you up here in quite a while. I haven't seen you up here.
The one of the things we always do is hire a local lawyer that's been there forever.
Mm-hmm.
I heard about Scranton issues, so we always get in there and they can talk local shop, and they usually take care of those negative Nelly issues that you're going to have by being an out-of-town investor. Because I live in Los Angeles, but I own in Texas, Georgia, and Florida, Colorado, and upstate New York. So, but I don't live there. So
yeah.
The local lawyers help out a lot. They move the ball down the field, so to speak, and talk the language of the locals.
I tell people all the time, man, you got to have local boots on the ground when it comes to this. I mean, Chris, the one client that I worked with this past year and buying all these motel conversions, he didn't hire anybody correctly. Like not one attorney he hired was correct. I try to put all the right people in place. He goes, "Oh no, I got this." I'm like, "No, you don't. You should have had permits already." He's like, "Well, no, my lawyer's working." I'm like, I even checked the zoning records. He never submitted anything. I don't know where he was going with stuff. But now he's got them all for sale and looming foreclosure on 7 assets that could have made him a lot of money and did a major changing in his investment space. It's amazing how people just don't want to listen to strategy.
We always have our architect file all our zoning stuff, so it just makes it's way quicker and faster. So
absolutely, you hit it right on the head, and thank you for coming by this morning.
Thank you.
Thank you. Diversifying in real estate strategy, isn't just smart. It's essential in today's market. Relying on only a single asset class or approach leaves investors vulnerable to market shifts, interest rates, or local regulations. You need to be able to reduce risk exposure, expanding your opportunity set, maximizing long-term wealth building, right? Ways to diversify your real estate portfolio. If you're doing single family, look at some 2 through 4 family. If you're already a 2 through 4 family, look at a 5+ unit. I tell people, hey, buy a 5 through 8 and just see if you like it. Don't shoot. I'm going to go buy a 100 unit. listen, there's not that many 100 units walking around, but there's definitely more 5 units through 8 units or 5 through 12 units for you to look at. Maybe look at a mixed use with residential blend. That's starting to make a comeback a little bit. Industrial warehousing, very nice. I mean, mobile home parks and RV parks are very nichey, very local. You really that's a whole more type of hands-on type of approach, but there's a lot of cash flow on those. The strategies, buy and hold, fix and flip, BRRRR, midterm rentals. We talked about corporate housing, short-term rental, STR and Airbnb, wholesaling. I also like the idea of arbitrage depending on the circumstances. And then you got to look at it from by geography, okay? Urban versus suburban versus rural, different cities and states, spreading out the legislative risk, growth versus cash flow markets. And the exit strategy, is it long-term rental for stability? Is it flips for quick capital? Is it lease options or rent to own for creative exits? So, diversifying doesn't mean doing everything at once. It means learning how to layer complementary strategies over time and adjusting as your experience in capital market conditions evolve. You can start with one core strategy and then add a different property type, a different geographic market, or even a creative financing approach. Linda, long time no see. I saw some beautiful pictures, some vacationing on for yourself there with your husband. It was really nice to see you out there having a good time the past couple of weeks. Brief overview who you are, what you do, and thoughts to niche versus mainstream real estate investments.
Good morning, Joseph. I hope you're doing well and you and Donna are enjoying the week. Hello, everyone. This is Linda Pliagas, and I'm the founder of Realty411.com. We're a real estate investing website, and we also produce live events, virtual events, and publications. Now, in regards to niche versus traditional real estate, when I think of traditional real estate, the buy and rent model is what comes to mind, where you purchase a property, multifamily if possible, for additional cash flow, and you may have to fix it up a bit, and then you rent it out for cash flow. That's a model that I use, and that's one that my husband and I have been investing in for over 20 years. It's worked out great. It's very traditional. Now, niche real estate are investments such as notes, tax liens, being a private lender, Airbnb, wholesaling, and like Brian said and mentioned, a new niche, the rent by room model. Now, at our last event that we had in Orange County, we also hosted a lot of different niche investments there. One of them was land banking, which is where we purchased land on the path of progress so that it can be sold within a few years for commercial development. And I totally agree with Chris and Joseph about the importance of diversification to mitigate your risk. One of the ways that we mitigate our risk as traditional landlords and investors is we have purchased in multiple states. We live in Santa Barbara County, but we have purchased in 4 other states besides California. That was one of the ways that, we wanted to diversify and not have all of our eggs in one basket in California. Another way that we mitigate our risk and diversify, even though we're traditional investors, is that we purchase different types of properties. For example, we have purchased multifamily properties, single family, even condos, even in PUDs, planned urban developments. We've purchased a vacation home on acreage. Yeah, so we hope to, soon purchase a commercial property, perhaps. That would be a nice addition to our portfolio. And in my opinion, it's important to fully understand what you are buying and what you are investing in. So I thoroughly believe in education and in investing in knowledge. So, if you want to get into syndication and multifamily, you may want to take a few boot camps in that niche. There's also a lot of great books and literature out there and online courses that you can take as well. And even reading books is so important and can really advance your knowledge on traditional and niche investments. And as an investor who has lost money in the past, I believe that you should start small to learn as much as you can, mitigate risk, and also never put all your money into one investment. And those are my thoughts. Thank you so much, Joseph, for putting this platform on.
Linda, thank you as always. We go back a couple of years now. I mean, we did a lot of events together. Hopefully, we'll re-collaborate sometime in the near future. So, thanks for being part of it this morning. Let's talk about the final thoughts too, and then we'll get maybe some final thoughts from Amy or Bob or Bob. The real estate business plan strategy for the rest of 2025, right? For investors, agents, private investors navigating today's volatile market. If you watch, this is just crazy watching week to week what's going on with the Trump administration and the Fed and tariffs and rates and job reports. It's just ongoing, onslaughting of things, surpluses. But how does that affect you, as an investor? You got to look at the vision and the objectives, the primary goals, like growing your portfolio, transaction volume by leveraging market corrections, right? The new lending opportunities out there that have not been in here ever. There's just so many opportunities to get money and the high demand of niches, right? The market strategy, like what is your target market? What is your asset focus? What are you doing to create lead generation channels? I feel the only off-market deals that are out there are the ones that are out there. People are earning and talking to people on the street. You got to be able to talk to people on the street, right? You got to understand financing and capital strategy. Why do you think we're offering a monthly discussion live to understand underwriting and how to broker loans? You have to be the smarter investor by understanding lending that much better. We're having those everywhere we can have them. Anywhere that's willing to allow us to schedule it, we're having those discussions, right? You need to understand leveraging lending trends. We like these classes this Saturday. We're going to dive into current information for you to understand right today. Understanding unsecured business lines, understanding leveraging that with non-QM lending, right? Operations and teams. Chris brought up a great point. Like your boots on the ground team, and like who's working for you as well. Like, do you have a VA with being your admin to facilitate the volume of business that you're trying to create? How are you growing? What type of educational events and education are you looking to go after? Right? It's got to make sense. Like to go out on an evening event, that subject matter has to be strong and has to tie into something that you're looking to put a feather in your hat. Amy, final thoughts.
Yeah, I would just say if you're choosing, if you're making a choice on any sort of real estate investment, no matter if you've been doing it for 10 years or if you've been doing it for 10 months, make sure just do your due diligence all the time, no matter what you're doing, and don't be afraid to know what you don't know, right? And be really good about being self-aware on that, because you don't want to get yourself in a world of hurt. So, but don't be afraid to do them either. But just make sure you're educating yourself all along the way. And I guess I should promote the room. The room Real Estate Rewired starts up next, right after this room. So y'all stick around. I'll start the room, and as soon as Joe closes this one.
Thank you, Amy. Bob, your
Yep.
final thoughts to niche versus mainstream real estate investments.
Well, you guys, excuse me, you've all heard some interesting niches, like for example, listening to how you rent out to do the Airbnbs, you rent somebody else's property to do that. There's all kinds of creative ideas, and probably some of the best ideas that we're going to hear about and be talking about in this room in another in another year or so are probably ideas that aren't even being tried yet. So, as I said, study the market, learn the local lingo, learn how to talk to the people, engage in a local, as you're hearing, engage in local team, such as a local lawyer or accountant that can help you in that market, and start investigating. And if you're going to go mainstream, that's fine. But if you're looking for a niche, you have to find the one. As I said, the thing that's going to make you rich is the thing that no one else has figured out yet. You've got to find where that niche market is, and maybe the niche market, if you're looking for one, okay, so maybe you're looking at a city, but okay, then maybe that city itself isn't a good idea, but especially in the Northeast where you have the township and borough structures for governments, sometimes the peripheral towns around a city matter. Like Pennsylvania is probably one of the more notorious ones for this, with the sheer number of townships, boroughs, and cities that the state has, and how big and small they are. Especially if you're doing Pennsylvania, like there's a lot of cities that are surrounded by townships that have the exact same name, but they're separate townships. And sometimes you'll even have separate townships with the same name crossing a county line. So look around, because what you might not be able to do right where you want to do it, 3 blocks down the road might be a different municipality where the rules are different, and you might be able to get away with it. And especially in a state like Pennsylvania, where the taxes go down to the local level, as far as wage taxes and whatnot, these things matter. So pay attention to your market, study it. You're never going to learn 100% of everything, but just pay attention to where you're looking at and what the other options are out there. You can fill in the hole very easily. Nothing I said was legal advice. Joe, back to you.
Bob, thank you. Amy, Brian, Chris, Linda, everybody, thank you for this discussion today on niche versus mainstream real estate investments. My last thought is either whether it's niche or mainstream, your communication has to be on point with your team. Has to be. I want to thank our sponsors, as always, Lenmark, MB Capital Solutions, Realty 411, Real Estate Mastermind Strategies, Percatech. We're here to provide insight, education, and strategy every Sunday morning, 9 a.m. Eastern Standard Time. My quote this morning is, breakthrough is how to distinguish a leader and who followed. Steve Jobs. Everybody have a great day. Please take care of yourself. Have a great week. We'll be back here next Sunday morning, 9 a.m. Follow Amy into the next room. Thank you, everyone. We'll be ending the room in the next 30 seconds. Thank you.